Chapter 11, Depreciation, Impairments, and Depletion. So in this chapter, we'll study depreciation, factors involved, computing useful life and salvage value, and then different methods that you've seen before, you're probably quite familiar with. Straight line, sum of the year's digits, double declining balance. Then we'll look at some other kind of unique depreciation methods that are used in special situations, and then maybe some issues that are related to depreciation that are a little bit unique and rare. Then we'll look at impairments, recognizing impairments, measuring them, maybe a loss. So we'll look at that. Restoration of loss actually is not allowed. And then assets to be disposed of. How do we determine that? And depletion, establishing a depletion base, write off the cost, estimating reserves, something unique, liquidating dividends is kind of unique to the depletion area, oil and gas extraction, that kind of stuff. And then some continuing controversies with two methods that are allowed for depletion. But there's been some controversy that one is not very conservative. And then we'll take a look at presentation and analysis of depreciation, impairments, depletion. So depreciation is the accounting process, right, of allocating depreciation in a systematic and rational manner. So it doesn't really fit the matching principle. We're not matching revenues with expenses. We're sort of artificially doing it by determining a useful life and then determining a depreciation method to use and then computing and then allocating that depreciation. So depreciation is just for fixed assets, machines and buildings. Intangibles, we use what's called amortization expense for goodwill, trademarks, copyrights, those types of things. That's in the next chapter. And the natural resources, we will use depletion expense, things like oil and gas, coal, what have you. So things, extraction, right? Things taken out of the earth. So we use the depletion expense for expensing those items. One thing I'll say about the depletion, you'll see that it's very close. In accounting, it's very close to the units of production method of accounting. All right, so 3 basic questions when looking at depreciation that really affects your depreciation cost. So what's the depreciable base? What's the depreciable base to be used? All right, so that's the amount of cost that we're going to allocate. What is the asset's useful life? Is it 5 years, 8 years? That's kind of subjective, but there are materials available that you can determine, within probably, maybe there'd be a little bit of error, but you can determine the general amount of that useful life. And then what method of depreciation is best for this asset? All right, so depreciable base, we have an original cost, and what takes into effect, of course, as you might remember, is salvage value. So we have to deduct salvage value, and then the depreciation base, or the amount we're going to allocate to expense, is $9,000. Except there is one exception, that a double declining balance, no salvage value. So original cost will be your depreciation base, so you don't have to deduct salvage value for double declining balance. Actually, you're not allowed to deduct salvage value for double declining balance. All right, so service life. So service life might differ from the physical life of the asset. The asset might still look good, but toward the end, it's not being very productive. It's maybe 20% of what its production was in year 1. So that, well, we want to take this out of service because it's not productive and it's wasting resources. So companies retire assets for 2 years. So physical factors, so it's casualty, something damages the machine, or expiration of its physical life. And economic factors, so inadequacy, we talked about earlier, it's only at 20 or 25% of its original productivity. It's inadequate, it's not productive, it's causing resources. Obsolescence, so we can get a new machine that's much better. This one's obsolete. It prepares a product that no one buys anymore. All right, so methods of depreciation. Activity method would be units of production. So instead of using years, we'll use this asset can produce 100,000 parts. All right, and then we'll use that as our depreciable base. Straight line method. So that's pretty easy. That if an asset has a 5-year life, we'll take 20% a year, right? 5 years. 1 year over 5 is 20%. So take 5 years. Sum of the years digits. So where you add up the digits, so it's a 10-year life, you add up 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Double decline. By the way, some of the years digits, we teach this, but it is used some, but really pretty rare. Double declining balance, or declining balance method. And then we'll talk about these special methods, group and composite and hybrid or combination. So this is illustration of straight line method. I'm sorry, this is an illustration of the activity method. So cost of the crane, we're going to depreciate, is $500,000, has a useful life of 5 years, $50,000 salvage value, and 30,000 hours. So 30,000 hours is going to be your depreciable base. All right, so if I use 4,000 hours, I'll divide 4,000 by 30,000. So that'll be my rate for that year, times the 450,000 cost minus salvage. So the amount that we're going to depreciate, right, is 450,000. Our depreciable base is 450,000. Our activity base is 30,000. So my formula then is just 4,000 divided by 30,000 times 450,000. So depreciation charge for this asset for the first year would be 60,000. So debit depreciation expense for $60,000 in credit, accumulated depreciation for 60,000. All right, here's straight line method. And so this same company and same machine. So $500,000, 5-year life. So we're going to basically depreciate 20% of our depreciable base per year. Cost minus salvage was 450. 50,000 minus 50. So 450,000 divided by 5. So 90,000, and that'll be for every year. We will depreciate $90,000 for each of 5 years. Okay, this is the declining balance method. Decrease. I'm sorry, this is sum of the years digits method, which is one of the what we call the declining balances or decreasing charge methods. That the first year will have the highest depreciation. So if we have an asset with a 5-year life, we add up the digits 5 plus 4 plus 3 plus 2 plus 1. There's a formula if you wanted to use it. And it might be if you have an asset 50 years, you may not want to, well, if you have a spreadsheet, but you can use this formula instead. I won't give you an asset with 50 years on the exam. All right, so each factor uses the sum of the years as a denominator. So 5 plus 4 plus 3 plus 2 plus 1 would be our denominator. So for year 1, we're going to take the most depreciation. So we're going to use this 15, and here's the 5 plus 4 plus 3 plus 2 plus 1. So year 1 is 5. So basically what we're doing is depreciating over these 15 years based on this 5, 4, 3, 2, 1. So the first year you'll see that it's highest, right? It's 33% in the amount of depreciation. It's 150,000, and compare that with what the production method was 60,000, and straight line was 90. So if you're interested, or if this is basically how what you think this is the most best systematic way to allocate those costs, then this method might be appropriate if you want to take a lot of depreciation at the beginning. So year 2 is 120, right? 4 over 15, year 3 is 90, and so forth. So if it was 20, well, let's say it was 3 years, just make it easier, 3, 2, 1. So 6 would be, right, so it would be 6 would be my total. So year 1 would be 3 over 6. Year 2 would be 2 over 6. Year 3 would be 1 over 6. So always start with the highest. So it's 5-year life, 5 is the numerator. Because you're, just remember, the first year is always going to be the most depreciation. All right, and this is the declining balance method, sometimes called double declining balance, because I think you use, well, you can use any percentage. That's some multiple of the straight line method. I think a number of companies, when they were, it was more popular, I think in the 80s and 90s, is not used as much now. It's used in tax quite a bit for, at least over the years it's been used in tax. All right, so we have a cost of a crane, 500,000, 5 years, 50,000, same thing, 30,000 productive hours. So we're going to use the the declining balance method. And for this, we're going to use 40%. So this is double declining balance. So we're going to do twice the rate. So remember, a 5-year life, we depreciate the depreciation base 20% per year. With this method, and you can use, any percentage you want, I suppose. But this company is going to use 20%, is going to use 40%. So double the straight line method. So we just take 500,000 and multiply for 40%. Now, one thing you notice here, right, is that with double declining balance, we do not use the salvage value in our calculation. But note at the end, though, the amount of depreciation we would have taken would be 40% of the 64,000. It might have been around 25,000. We only took 14.8 to get to the ending book value. The ending book value is going to be the salvage value in year 5. And that's because you could probably sell this asset, for 40,000 or 50,000. So to depreciate it down to 0, would we be overcosting, overexpensing that asset? So that's not allowed if you're going to get some residual from it. So you can only depreciate to the salvage value. And there's a couple of things to talk about a little bit here is the special depreciation methods, group method, and composite method. So group method, assets are similar in nature and have the same useful lives. So we do a group amount of depreciation. Composite method is used if they're not similar and have different lives. So this one, Mooney Motors, establishes a composite depreciation rate for its cars, trucks, and campers, as shown below. So it has, and you can see cars, trucks, and campers, I would say those are similar assets. They have similar useful lives. Okay, so we take out the salvage, and here's our cost, 120, 40, and 30, and we'll use straight line for each line, right? Cars, trucks, campers. So I got 40,000, 10,000 for the second one, like 120 divided by 3, 40,000 for cars, 10,000 for trucks, 40,000 divided by 4, and then 30,000 divided by 5, 6,000 for campers. What's important here, though, is this total depreciation of 56,000. And then we'll divide that by the original cost. So our composite depreciation rate is 25%. And then our composite life, we take the 190 cost and divide by this 56,000 of depreciation per year. So 3.39 years of depreciation, basically, is what they're saying there. And then the composite rate, which we can then use as this percentage, we can then use on all of our cars, trucks, and campers. Once we establish the rate, then we'll use that year after year to compute depreciation on all our cars. So we have a lot of them. We don't want to depreciate each one individually. So we'll just use that rate and multiply it by the total depreciable cost, and that'll give us our depreciation expense for the year. If we retire an asset before the life of the group is reached, it buries the gain or loss in the accumulated depreciation account. So we're not going to take any gains or losses because there may be so many of these that we'll just bury it, and it's not going to be really material. So we'll bury it in accumulated depreciation. So if I sold a camper at a cost of $5,000 for $2,600 at the end of the third year, so my entry would be debit accumulated depreciation for $2,400, debit cash $2,600, and credit card. So we have debit cash $2,600 and credit cars, trucks, campers for $5,000, and so we see debits don't equal credits. So the $2,400, the gap, I guess, would be charged to accumulated depreciation. Companies are, they're free to develop their own tailor-made depreciation method as long as they can defend it to their auditors, and their auditors are going to say, "Hey, is this systematic and rational?" If it's not some kind of, weird depreciation approach that really doesn't measure depreciation expense effectively, then the auditors are probably going to decline that method. So we talked earlier in the semester about changes in estimates, and they're continually inherent part of any estimation process. That useful life might be incorrect or salvage value, whatever. So it's counted from the current period perspective, so no charges or no changes to previously reported results occur. So we have a high school and they purchased $510,000 of equipment, 10-year life, residual of $10,000. Depreciation has been recorded for 7 years on a straight line basis. In 2017, it was determined that the estimated life should be 15 years instead of 10, with a residual of $5,000 at the end of the time. There's no journal entry then at year end. We've already recorded the depreciation expense. We're going to record new amounts of depreciation expense for years 8 through 15. All right, so we had recorded for the first 7 years $350,000 depreciation. So the equipment had a book value of $510, original cost of $510, original book value of $510. Subtract out the cumulative depreciation, $350, 50,000 times 7, $350. So our net book value is $160, right? $160,000. So that's going to be the new amount that you're going to use to depreciate for the next 7 years. 8 years. So now we got a net book value of 160 computed here. And then all right, so a net book value of 160. New depreciation 19,375. 155,000 divided by 8 years. So the annual depreciation is 19,375. All right, and that'll be the depreciation for, since they're using straight line, that'll be the depreciation expense every year for the next 8 years. All right, now let's talk about impairments. So carrying value of an asset is not recoverable. Company records a write-off, and that's referred to as impairment. So what can lead to an impairment? Decrease in fair value of the asset. So maybe there's newer assets that are out that are better, your asset loss value. Significant change in the manner in which an asset is used. So maybe you used it a lot more. Significant adverse changes in legal factors in the business climate that affects the value of an asset. So something affected by a lawsuit with our machine. Accumulation of costs in excess of the amount originally expected to acquire or construct in that asset. And then finally, a projection or forecast that demonstrates continuing losses associated with the asset. All right, so measuring them can be difficult. So review events for impairment. If the review indicates impairment, we'll apply what's called a recoverability test. If the sum of expected net cash flows from the asset is less than the carrying amount, then you have an impairment. Assuming the impairment, then the loss will be carrying value versus fair market value, which is the market value or present value of expected future net cash flows. So this chart kind of discusses it. So we have an impairment, assets held for use, will determine the loss, depreciate on new cost basis. We don't restore the impairment loss. If the asset's we're going to get rid of it. The excess of carrying value over fair value, same as this, will be your impairment. We don't take any depreciation. We are allowed to, and we will take a loss, and we are allowed to restore the impairment loss in this situation. So we'll look at these examples. So Emmylou has equipment that, due to its changes in its use, it we use for possible impairment. Equipment's carrying value is $600,000, so $800,000 cost less the $200,000 equipment depreciation. So there's your carrying value or your book value. We determine the expected future net cash flows from the use of equipment and its eventual disposal to be $650,000. So if we look at this, the expected cash flows are $650,000, but the carrying value of the asset is $600,000. So really, in this case, even though apparently those cash flows have reduced, there is no impairment because your future cash flows are above your accumulated depreciation. So as long as future cash flows are above the accumulated depreciation, we will not have an impairment. So nothing is done. No entries, nothing. We just go along as we have with those assets. No different depreciation or anything. All right, here's example 2. Emmylou now has equipment that, due to changes in its use, it reused for possible impairment. Carrying amount is now $600,000, $800,000 less the depreciation, cumulative depreciation. Emmylou determines the expected value, expected future net cash flows from the use of the equipment is only $580,000. So now we do have an impairment of $20,000. All right, and then the third is the recoverability test indicates net cash flows of $580,000 are less than the amount of $600,000. Therefore, an impairment has occurred. Assuming that the fair value is $525,000, so then the loss would be $75,000. So you take the fair value of the asset, compare that to accumulated depreciation. The accumulated depreciation is larger, so your impairment loss is measured then at $75,000. All right, so a fair value of equipment is $525,000, cost is $800,000, depreciation is $600,000. We've got a loss of $75,000, and we'll credit accumulated depreciation. All right. Restoration of the impairment loss. So after recording the loss, the reduced carrying amount becomes its new cost basis. No change in new cost except for depreciation or amortization in future periods or for additional impairments. No restoration of impairment loss is allowed for an asset for use. However, if the asset is going to be disposed, you can take the loss, as we saw in the last slide. So the rationale for not allowing companies to restore that impairment loss is that the new cost basis now puts the impaired asset on an equal basis with assets that are unimpaired. All right, so they feel that's misleading to our shareholders. So it's just I think a conservative way to approach that. And the impairment assets to be disposed of, like inventory, we should report them at lower cost or net relative value when determining, this loss. You can write up or down an asset held for disposal in future periods as long as the carrying value after the write-up never exceeds the carrying amount of the asset before impairment. So you can write down the asset for disposal, held for disposal, if the carrying value is less than the carrying amount of the asset before the impairment occurred. So you can also record gains if it went up in gain. Should report loss or gains, as part of continuing operations. Finally, depletion. The natural resources, petroleum, minerals, timber, gas, oil, so forth. Two main features: complete removal, consumption of the asset, and replacement of the asset only by an act of nature. So computation, computation of depletion base includes 4 factors: acquisition, exploration, development, and restoration. So normally companies will compute depletion, cost depletion, on a units of production method, right? Like I mentioned earlier, it's an activity approach. So depletion is a function of the number of units extracted. So it's basically the same formula you used before. So take total cost minus salvage and divide by units available. So that's the depletion cost per unit, might be $1 per unit. Multiplied by number of units extracted, 4,000. So 4,000 would be your depletion. Estimating recoverable reserves. So same as accounting for a change in estimate. Reduce the depletion rate on a prospective basis. So maybe we underestimated what our depletion rate was and revise it. Well, all we need to do is take depletion expense. Let's say it was 8 years, it's a 15-year asset. We took the first 8 years of depletion. Now we're just going to record that new base over 7 years. Same thing that you would do with depreciation. Liquidating dividend is sort of a unique thing that we have in the extraction industries. So Callahan Mining had a retained earnings balance of $1,650,000, given depreciation of $2.1 million, paid in capital of $5,435,000. Board of directors declared a $3 dividend on 1 million shares outstanding. So record the $3 million cash dividend as follows. So we'll credit cash. We only have $1,650,000 in our retained earnings. So just a point of note, probably a good idea not to give a cash dividend greater than your retained earnings. But in the extractive industry, you are allowed to do that. But you're going to wonder where the rest of the funds come. They come from paid in capital in excess of par. All right, so that'll be debited for $1,350,000. So here's a little controversy with oil and gas, that there's full cost and successful efforts concept. Sorry, I have a cold, so hard to enunciate today. So full cost is cost of drilling a dry hole. It's cost needed to find the commercially profitable well. So that's, you're allowed to cost for those. Both methods are allowed. And then for successful efforts concept, only capitalize the cost of successful projects. But you're allowed to use either full cost or successful efforts concept. All right, and then the presentation on the financials. So record depreciation expense, income statement, balance of major class of depreciable assets by nature and function. So you show cost and given depreciation on the balance sheet. Then in the notes, you might describe how you're accounting for those assets, depreciation or depletion wise. All right. Well, thank you for your attention. Have a good week. Good luck on the test, and we'll see you shortly.